The U.S. Federal Reserve is set to raise rate between 3 or 4 times this year. Many bond investors, they want to know what is the impact if the rate hike gradually in U.S. And today we invite an expert from Aberdeen Asset Management, Donald Amstad. He has nearly 30 years investment experience. Hello, Donald.
Hello there. Thank you very much for having me on your show.
Donald, could you tell our investor what is the impact if the rate hike gradually in U.S.?
The Federal Reserve raised interest rates and the market response was quite surprising because the US dollar fell and the stock market is higher and credit spreads are slightly narrower. So actually the overall impact of the Fed raising interest rates, I think looking forward, there are several things to take into account. If the Federal Reserve wants to tighten monetary conditions in the United States, there are several ways it can do that. Firstly, it can raise interest rates, and secondly, it could reduce the size of its balance sheet and sell down some of the assets that it has acquired during the quantitative easing program. So I think it's not just a question of what does the Federal Reserve do in terms of interest rate hikes, it's also a question of what it does with its balance sheet. And then because we live in a global economy, I think it's also very important to keep an eye on the two other very important global central banks. That's the European Central Bank and the Bank of Japan. So my advice to bond investors is not just to focus on the Fed in terms of what their policy with interest rates is, but also to focus on what they do with their balance sheet and also to keep an eye on the ECB and the Bank of Japan. So it's a very complicated global situation, but at the moment, I don't think there's any reason for bond investors to panic because monetary conditions still remain very easy. And even if the Fed raises a couple of more times this year, then unless they start to wind down their balance sheet, and unless the ECB and the Bank of Japan also start either raising rates or reducing the size of their balance sheet, then on the whole, it's likely that monetary conditions will remain relatively easy.
And you're speaking about the ECB and Japan. So overall, in your opinion, what is the impact of political issue would affect bond market? Such as this year we have Donald Trump, US president policies, and the UK is going to leave EU, Europe officially this end of month. What is your observation?
Yeah. I think one has to keep a very close eye on politics. As you mentioned, we have Donald Trump in the United States, and we are trying to work out what policy he will be able to deliver. Will he deliver a tax cut? Will he deliver fiscal stimulus? And if he does, how will he finance it? And how will he get these measures through Congress, which is controlled by the Republican Party? In Europe, we've had the Dutch election, which went better than expected, but we still have very important elections in France and Germany to come later this year. And my home country, the United Kingdom, Mrs. May has announced that she will send the letter to the European Commission on the 29th of March. So there is a lot of political risk around. What is very surprising again is that despite the very high level of political risk, the level of volatility in the market is very low. Whether you look at the level of bond market volatility or whether you look at stock market volatility, it's very low. And that is because monetary conditions are still very easy. And I think there's a real debate as to, given how uncertain the political backdrop is, can the central banks in the West really tighten monetary policy aggressively. And I think what the markets are saying is that because the political uncertainty is very high, the tightening that's going to come from the central banks is going to be very small, and therefore that's why volatility continues to remain very low. But although volatility is low, I think your investors should understand that risk is very high. And when we look at where risk is low and volatility is low, then it's very interesting that when we look at the markets in Asia, it's very interesting that, for example, Asian currencies now have very low levels of volatility. And that is, we think, reflected by Asia's better fundamentals. So maybe bond investors who are currently focusing on the bond markets of the West, where volatility is low, where yields are low, but risk is high, should switch attention to the bond markets of Asia and maybe emerging markets, where fundamentals are improving and where yields are still quite high.
So, in your opinion, you recommend the emerging market bond than the U.S. bond? I mean, the Treasury.
Yes, I think it makes sense to lend money to governments where fundamentals are improving. And of course, emerging markets generally have had a very troubled last couple of years. But finally, the very tough medicine that these governments in the emerging markets have taken is beginning to pay off. I mean, if you take the examples, for example, of Russia and Brazil, the central banks in those countries behaved in a very orthodox fashion when commodity prices fell. They let their currencies fall, which meant that inflation went up, so they raised interest rates, and they crushed the domestic economies. You know, the domestic economy in Brazil and the domestic economy in Russia has been very, very weak for the last couple of years. But because the economies have been weak, therefore the current accounts have swung from deficit back into surplus. Inflationary pressures have now peaked, and as inflation comes down, so central banks in countries like Brazil and Russia can start cutting rates aggressively. The currencies are strengthening because capital is beginning to go back into emerging markets. So yes, I would say that emerging market bond funds look very attractive in the current environment because fundamentals are getting better.
We mentioned about the emerging market and Europe, and any other region you would personally recommend for bond investor?
Yes. Well, within emerging markets, we have one fund called the Aberdeen Select Emerging Market Bond Fund, which invests in both hard currency bonds and local currency bonds, sovereign and corporate. And that fund has a very attractive yield at the moment of about 7%. So I think that's a very interesting fund for investors to look at. But I think one area where we see a lot of opportunity in emerging markets is in corporate bonds. And we also have an Aberdeen Emerging Market Corporate Bond Fund. And the attraction of corporate bonds is that in emerging markets, there are some very, very well-run companies that happen to be located in some rather weak economies. So, I mean, one example, for example, is ICICI Bank of India. Now, our view on ICICI Bank is that if you took the bank out of India and put it into Europe, it would probably be a single A rated bank. But of course, the credit rating agencies can't rate it single A because it's in India, and the sovereign, India, the sovereign, is triple B minus, Baa3. And there are lots of other examples of very high quality companies whose credit rating is very low because of the country where they operate. So from a risk point of view, Aberdeen thinks that emerging market corporate bonds is a very interesting space to go and look for high quality assets, because the quality of the companies we're lending to is very high. The spread is very high because the rating is low, but actually we think the quality of the companies is extremely high. So within emerging markets, I would say emerging market corporates is a very good opportunity. And because companies tend to issue shorter maturity bonds, then the duration of emerging market corporates is much lower than other emerging market bond indices. So if you have clients and readers and listeners who are worried about the Fed raising interest rates, maybe emerging market corporate bonds is a very good place to invest right now.
Okay. So now we understand the outlook of bond market, but many investors, they worry about the exchange losses. How to avoid it?
Sure. Well, I think a lot of people expected that after President Trump was elected, that his policies would make the US dollar stronger. I think that view is beginning to change now, because firstly, the market is realizing that although President Trump has promised a lot, so far he hasn't delivered very much, and he has to go through the political process in Washington, and that is very slow. So, for example, his tax reform measures, it's already been talked that maybe those reform measures will come out later this year. Some people now even talking about maybe 2018. So I think the expectation that Trump can change things very quickly is beginning to disappear. And so many people who had a bullish US dollar view at the end of last year are now changing their mind on the dollar. And of course, they now understand that President Trump doesn't want a strong dollar. He actually does want a weak dollar. And so the sentiment in the currency market is changing, and the US dollar is beginning to weaken. But I think that if you want somewhere that can appreciate and somewhere that has good yield, then I think the bond markets of Asia and emerging market bond markets is a good place to be, because you have a combination of improving fundamentals, you have quite high yields in countries like China, in countries like India, in countries like Russia, in countries like Brazil or Mexico, and you have the potential for currencies to appreciate. So again, it coming back to what is the right fund for your investors to choose, then I would say emerging markets looks very interesting opportunity, and particularly India.
And thank you very much to come here, and thank you for watching.
Thank you very much indeed.